the Fed is once again facing buying back borrowed Bank of International Settlement gold leases into a 17-month series of physically determined higher prices. And the last tool in the toolbox, we're just pointing out, is blunted, and there's just not enough speculators left to lay paper gold liabilities onto to offset how much unallocated gold and silver is being alchemized by China and Russia right now, right under our noses. Well, that really just leaves one question. We global gold and silver buyers are no longer in the minority. We used to be. We're not in the minority anymore. So my question is, have you also joined the global majority movement who are as quickly as possible converting their rapidly depreciating debt fiat currencies for physical gold and silver?
Gold has surged to a fresh record high after the U.S. confirmed import tariffs on 1 kilo gold bars, shaking global bullion markets. Futures peaked at $3,534.20 before settling near $3,488.90, up 1% on the day and track for a 2.4% weekly gain. Amid these moves, Andrew Maguire, a London-based precious metals trader and whistleblower, warns of a more profound structural shift. He argues that supply-demand fundamentals point to gold's fair value at around $8,000 an ounce, a conservative estimate. Maguire highlights how a $100 futures premium, leveraged at 96:1, has long capped gold below $3,500, but believes these manipulative tactics are weakening, potentially paving the way for a significant price breakout. Meanwhile, China is accelerating its efforts to wrest pricing power from Western exchanges. The Shanghai Gold Exchange has opened its first offshore gold vault in Hong Kong, enabling trading in yuan rather than US dollars, a direct challenge to the dollar's dominance in bullion markets. As the world's largest gold producer and consumer, China is moving to strengthen its influence over global pricing. At the recent BRICS summit, Maguire underscored how China's rapidly expanding vaulting network, stretching from Singapore and Hong Kong to Saudi Arabia, Russia, Brazil, Africa, and Southeast Asia, is already providing enough physical market liquidity to benchmark a globally determined, physically delivered gold price. This is more than a regional initiative. It's a coordinated effort by central banks, sovereign wealth funds, and safe haven buyers to shift the center of gravity in precious metals away from the LBMA and COMEX. For decades, Western paper markets have dictated prices, but the tide is turning. As Maguire's analysis shows, the combination of strategic infrastructure, physical market dominance, and a weakening ability of Western actors to suppress prices is setting the stage for a new era in gold, one where price discovery occurs in physical markets, not in leveraged futures pits. And when that transition is complete, the revaluation he has been forecasting may happen faster than most expect. In this video, we dive into Andrew Maguire's outlook, not only on gold, but also on silver, the dollar, T-bonds, and the broader commodity complex. He sees a sequence of dominoes that will fall, triggering an abrupt acceleration in the price of precious metals. And based on historical market behavior, silver may be setting up to outperform. So stay tuned. If you find value in serious, data-driven commentary on the financial system, make sure to like this video and subscribe to the channel for more weekly insights.
Now, we've been drawing a lot of attention to how the only tools left in the LBMA CME gold price suppression toolbox are failing and are ultimately leading to an imminent US Treasury gold price revaluation. Now, the scope of tool number one, which is the gaming of the COMEX exchange for physical premium. In other words, there's a COMEX price and it has a premium versus the Basel III compliant backdoor, which is usually a lower price. So one starts off high and then they kind of marry together as the contracts expire. So I want to go through them because it really confuses a lot of people. And it really should be simple. And I think by using a chart, we'll look at how simple actually it is. Because what's happening is that this tool number one is essentially the COMEX market. We're witnessing the COMEX market, the exit of the liquidity, and that's going into the global physical delivery markets. And then there's a tool number two, which is just it's the in conjunction with this first tool. What you do is drag in, led by the nose, a dwindling number of paper market speculators, lead them by the nose to take the bait. Now, note how this $100-odd premium, leveraged at around 96 to 1, had enabled gold to be pinned for 4 months in a row, capping gold from rising above, let's just raise it up here, capping gold rising above 3,500 to $4,000 an ounce. Well, 34 to 3,500 actually. But as we will demonstrate, and here just as a perfect example, again, this is where a prior contract opened, and then suddenly down it goes, and then again, same process. And the reason I'm doing this again is to understand why it's not going to work anymore. But nevertheless, that $100 premium leveraged at 96 to 1, really, it has maintained a cap, but it is backfiring. And guess who against? The only actor still trying to cap a rising gold price, which is the Fed. Now, if you remember, putting this into context, 2 months ahead of gold being reclassified as a physically deliverable Basel III NSFR first tier high quality liquid asset on the 1st of January. And this they covered just before that. It's basically 2 months ahead of that, in the know that gold was going to rise. So they covered all their remaining 500 tons of gold derivative bets. And they did that alongside every single global central bank, sovereign and bullion bank, ditching all their gold derivative risk and going long for their own books, all in tandem, anticipating higher prices. Goodness, even the outlier Citi has now reversed its bearish gold stance, now calling for 3,500 in November. If you remember, it was Citi that was calling for hundreds of dollars lower and failed to get it. Now, if you remember, we drew attention to these bets, and these are foreign exchange bets, unallocated foreign exchange bets that trade outside of the futures market. These bets were made by the Fed. Now, their agent bank, JP Morgan and Citibank, were the primary. Goldman has long escaped capping gold. So the two primary banks that we drew attention to, and if you look at the precious metals 5 years maturity bets, so JP Morgan and basically Citibank were the only two making derivative bets out for 5 years. So now, look at where we are now. They've covered. So it says everything. And as we've assessed in the past, these bets are undoubtedly linked to the 8,133 tons of rehypothecated US Treasury gold. And so that's proof of capitulation, because since the last report, JP Morgan and Citi have exited their longer-term bets. This gap close also captured in the daily charts, which we've seen in the past, time after time. But essentially, the only bad actor willing to risk exposing themselves to fight the losing proposition of a rising gold price against the dollar is the Fed. And as we just witnessed, the lack of futures market Basel III compliance has once more enabled them to employ futures market leverage to synthetically dilute the price into an end-of-month mark-to-market event. And if we drill down into, say, the very short-term charts, it's pretty clear. This was 100% an official driven overshoot of very strong physical demand. And it was jumped on by the physical exchanges. The reason they did it here was exactly, this is the point where they have to value these huge bets that were made, billions of dollars unallocated foreign exchange gold and silver direct bets. Yeah, so following on from our last episode, where we delved into the gold-backed tokenization and financialization of really potentially trillions of real-world assets, and based purely on supply-demand gap filling, this leads to a fair value price of 8,000 gold, and that is conservative. It was not unusual to evidence, if you remember, we used to see $50, and in fact as high as $100, but we used to regularly evidence $50 higher prices, yuan gold prices, than London, and how this regularly drove a massive arbitrage opportunity as underpriced Western exchange traded fund and COMEX gold and spot gold, unallocated spot gold, was drained to capitalize on these real world premiums. Therefore, due to its global fungibility, and this is the key because gold is fungible globally, when the price of gold in yuan is higher than the LBMA fix, nations seeking to pay or deliver commodities in exchange for their national currencies, they'll simply buy London spot and arbitrage the difference. This has created a backwash into the LBMA fixes, forcing really unwanted discipline upon it, because the unallocated gold in London, other than at the fixes, has up to a 20% haircut. Now, as we drew attention to during the BRICS summit, backed by central bank sovereign and fresh safe haven physical demand, China's expanding Shanghai vaulting network that's been established, it's being established in Singapore, in Hong Kong, Saudi, Russia, Brazil, Africa, Southeast Asia. It's global already, and they're already, this group, these vaults have already aggregated sufficient physical market liquidity to benchmark a global, physically determined supply-demand gold price to be locally delivered. Now, tokenizing BRICS collaborations into stablecoins and backed by real assets, along with a race to secure as much gold as possible to back the value of each nation's foreign exchange currencies, provides the BRICS nations and their counterparties with a very liquid 7-second settlement process, maximum 7-second settlement process. And bearing in mind that you've got vaults around the world where literally a T+0, because it's fungible, a T+0 delivery can be moving gold from one side of a vault to the other nation's holdings place. So while everyday BRICS pay transactions that people look at are not directly backed by a weight of gold, they're ultimately underpinned by a yuan gold standard. So sales of goods and services and commodities are valued against gold. So that's how they're benchmarked, and then directly convertible into physical gold. This is what is going on. It's just not realized. Ultimately, with gold increasingly backing real-world assets, the US administration...
While silver's explosive potential remains untapped, Andrew Maguire identifies BRICS nations, particularly China, as the strategic force deliberately restraining immediate price acceleration to $50 or even $100 per ounce. The precious metal is positioned for controlled ascension, with sophisticated buyers maintaining market trajectory discipline despite having the power to trigger immediate surges. Maguire suggests that once geopolitical tensions intensify or supply constraints tighten, likely following Russia's continued diversion of its 1,400 tons of annual production to military stockpiles, silver's supply-demand imbalance could propel prices far beyond current forecasts. Maguire is also closely monitoring COMEX delivery mechanics, where the August contract rolled into December at a $59 premium, a structural indicator he hasn't seen replicated across multiple delivery cycles in recent years. This isn't just another roll differential. Maguire argues that if delivery premiums continue expanding, at the same time New York vault inventories decline, it will signal the breakdown of paper price suppression that has defined silver markets since 2011. But this time, he doesn't expect Western institutions to lead the breakout. While HSBC's forecast of $35.14 for 2025 remains conservative, Maguire believes Eastern accumulation patterns, central bank diversification, and military demand will create the catalyst, with traditional fundamentals acting more as a lag indicator than the primary driver. Let's get back to the interview.
Yeah, with the physical silver trade now largely bypassing local London, we looked at this last time, these same actors in silver futures are still exposed, well, not just silver futures, but also to unallocated spot silver, are still exposed to these Office of the Comptroller, OCC derivative bets, which are being targeted for delivery by the physical markets and have become increasingly difficult for the Fed to cover. And this is evident by way of declining open interest, or let's say the number of chips in play. Now, with the COMEX silver market paper settled liquidity alongside producer financing initiatives, all leaching out into the Chinese physical exchanges where they're properly benchmarked, silver has now largely escaped the LBMA stranglehold. Now, these same actors are having difficulty in containing silver. Now, the reason it hasn't spiked any higher is that savvy buyers, the controllers, are in China, and they're sitting back and letting the specs and the paper market guys do their thing. They've got control. They can let this run to 50 tomorrow. They can let it run to 100 tomorrow. But it doesn't suit them right now, but it's coming. Now, also, let's not forget, Russia is the 8th largest global silver producer and is estimated to produce about 1,400 tons of silver in 2025. Now, with the Russian central bank and the military complex recently diverting local production to stockpile silver, liquidity providers assess that this additional global offtake is not factored into the current supply-demand silver price, which is already in a deficit. And it is so disruptive, it tips the global supply deficit to force other competitive buying from China, India, and also from consumers who are going directly to the mines to produce, to source supply. Now, while spot silver is not Basel III compliant, it's important to understand this. Yes, it's not Basel III compliant, but it is a deliverable foreign exchange cross against the dollar, pound, euro, etc. And as with silver, and because silver supply is getting priced outside the LBMA's control, the Loco London Global Silver FX Fix benchmarking the global physical supply demand settlement price will have to rise to meet this fresh demand. And that's further going to drain Loco London's supply, which is already at critical levels. Now, the silver fix actually benchmarks a direct producer to end user price. And so any discrepancies are simply being arbitraged. And liquidity providers report continued accumulation of underpriced LBMA CME silver is currently now in the BRICS crosshairs, as it have been for some time, but it's stepping up. And very, very, very short term, silver under $38 is unsustainable. And as we recently indicated, silver well into the 3 digits. Now, while this tokenization gateway opens up every single commodity to be traded and settled intra-BRICS national currencies, we've been focusing on the West's gross underestimation of BRICS nations' ability to take full control of the gold and silver price setting mechanisms, just understanding that when a leveraged, unbacked futures contract for gold or silver moves into expiry, as the August contract just did into the end of July for delivery on the 1st of August, it loses all its premium, which is called contango. And then it trades at the same price as the deliverable spot Basel III compliant global facing foreign exchange market, where it's possible to actually take delivery of a physical bar. Everything's going to make sense because as the August contract expires, reach the same price as the deliverable contract. It makes sense because that contract just expired. So traders who don't want to be forced into taking delivery of their August COMEX longs or the shorts being demanded for delivery, they either exit or close and then roll further positions into the next liquid contract. In this case, it was the December contract, which at a rollover price that traded $59 higher premium to the deliverable spot contract. So that'll all make sense when we look at the charts. Now, the futures premium price over the spot price, what it does is allow for the carry costs. There's insurance costs, there's storage costs, etc., until the December contract goes into delivery on the first day of December. So obviously there's a period between August and December. But as a side note, given that gold is only fractionally held, the cost to carry is actually arbitrary. However, with the general mechanics understood, let's dig into the charts to uncover these footprints. So, and guess who's setting the COMEX price right now? So as we've just highlighted, really, the Fed is once again facing buying back borrowed Bank of International Settlement gold leases into a 17-month series of physically determined higher prices. And the last tool in the toolbox, we're just pointing out, is blunted, and there's just not enough speculators left to lay paper gold liabilities onto to offset how much unallocated gold and silver is being alchemized by China and Russia right now, right under our noses. Well, that really just leaves one question. We global gold and silver buyers are no longer in the minority. We used to be. We're not in the minority anymore. So my question is, have you also joined the global majority movement who are as quickly as possible converting their rapidly depreciating debt-pat fiat currencies for physical gold and silver?
Andrew Maguire's analysis paints a picture of global precious metals markets standing at the edge of a structural transformation, not because of some distant, theoretical shift, but because the very mechanisms used to suppress prices for decades have now created an irreparable fragility in Western paper markets. China, faced with a choice between accepting Western price manipulation or establishing physical market dominance, will always choose sovereignty. They will build vaults, they will accumulate metal, and they will systematically undermine the very system most investors still mistakenly trust: COMEX and LBMA price discovery. Silver remains the most underappreciated beneficiary of this east-west power shift. Its manipulated pricing, exploding industrial demand, and deliberate restraint by BRICS mean that once the paper market breaks, and it is already fracturing, the upside could be explosive. Add to that the delivery stress emerging from COMEX mechanics and expanding vault premiums, and we are likely looking at a synchronized breakdown in artificial price suppression. What happens when the world's largest gold producer decides it no longer wants to play by Western rules? If you found this analysis valuable, please consider liking the video, subscribing, and sharing it with other serious investors who need to understand this shift. We'll continue to bring you the sharpest insights from precious metals markets and the intelligence to navigate the revaluation ahead. Thanks for watching.